Good afternoon, traders and investors. Welcome back to none other than Stock Market Movers. I got another great show for you guys today. We have some topics to get through. Of course, this is the show that gets you through all the headlines out there in the stock market and gets to two expert opinions in one show. We got another great one for you. We'll touch on ECB interest rate hike, natural gas stock news, stock market gainers, Tesla earnings, United Holdings, Carnival Cruise offering, Microsoft, Amazon, Ford, inflation, Fed outlook, risk and uncertainty, portfolio building, all of this in one show here in 1 hour. I'll do my best to get it through. Today, we also have some great guests. We have Randy Frederick, Managing Director of Trading Derivatives at Schwab Center for Financial Research. And we also have Dr. Richard M. Smith, Market Risk Analysis. Can't wait to get into that. I want to talk about portfolio building and risk. And early on, we'll get into it at 1:15 with Randy, talking about some more macro outlooks. We'll touch on what the Fed outlook is coming on up, and definitely we'll see what happens in the environment right now, and we'll take a look at the market. Let's dive on in. Let's take a look right now at our SPY. How are we trading on there? I'm going to go ahead and bring this up here. Looks like we're up there towards the 397, almost holding above there. I think we still got room, into the shadow. We started really getting into that shadow above the 395. I think we're going to start running into around where we get the 50-day moving or 60-day EMAs that I have right now set up into that 400 zone. That's where I think we could run into some resistance, but definitely a strong day in the SPY overall. Let's take a look at that interest rate hike news. Of course, the ECB coming in here and raising the rates to 50 basis points versus the smaller hike that was expected of 25 basis points. That definitely shaking up a little bit the ECB, of course, but what they saw were higher inflation numbers. Just like our Fed is data dependent, ECB making their move there. Also, you got some Nord Stream pipeline news today, right? The data showed that essentially the flows were roughly back to the same levels. And I think that's something to keep on watch, how that definitely kind of plays out, that whole situation. You can see how UNG has been reacting lately. If you take a look at UNG, that's been really pushing well. It did pull back a little bit here, but then we got that spike in the afternoon around 10:35. You saw that spike right back up. And it's going to be, playing out here. What happens here? Does Russia continue to strong arm natural gas? It's going to be something to watch. Definitely the pipe flow came back today, but that also leaves them room, right, to battle, to take it away from them. Just like a salesman, sometimes, you give somebody something and then you take it away. We'll see what happens if Russia pulls that move also. Let's get out of that. We can touch a little bit about the economic data that came out today. We did get initial jobless claims here. Initial jobless claims came a little bit hot at 251,000 over the 240,000 expected. But I think this is what we're pointing to, right? We're also pointing that the jobs market has continued to stay strong. And overall, the Fed is trying to, engineer here a soft landing. And at least for the time being, the jobs market still hasn't really shown struggles. We keep hearing mentions from companies, right? Slowing down hirings. You're seeing layoffs. We'll also talk about it a little bit later. Microsoft slowing down some hirings also. So I think in the long run, we need to continue to watch the jobs numbers. But for right now, not an alarming rate increase here. Let's continue going. You also saw the Philly Fed manufacturing index come in worse than expected there. This is where I could say that definitely you're seeing some more contraction. Of course, anything below zero shows us contraction. Last one was actually at -3, 3.5, and now you're seeing -2.5 was expected. We went as high as -12.3 here, so showing us more contraction in manufacturing and the factory sector growth. That's definitely going to continue to bring us down, but let's get out of that. Let's go to what was hot and what was not. My favorite segment of the day, and going through what was moving and what wasn't here. So healthcare actually led us. So you got healthcare, technology, and consumer cyclical. Healthcare leading the way here. What was doing well in healthcare? Well, it was diagnostics and research. You can see here up about 4.1%, the industry overall. What were some of the big names there that were moving? Well, you got Thermo Fisher making a nice leap on up today, up about 6.18%. That's definitely one I'd keep on my radar. And DHR also taking a big step up. Look at these daily candles. There's not many times you'll see a daily candle like this on DHR. And there's some bottoming that was put in here around the 250. So I'm going to continue to watch this one. It did get down there to as low as 230s, but interesting move right back up. And we've been paying attention also to some different areas. If you can take a look here, medical instruments and supplies, what was doing well there. You had Intuit Surgical bouncing back a little bit off of the ground. That's made a good move in the last couple of days. We'll see if this can continue pushing. Now, another area that we've been watching is biotechs, right? And so stocks in that have been doing well is Moderna. Moderna not doing too bad today, trying to hang on. It's but sideways near the VWAP there. We'll see if it takes another leg up on Moderna. But another area that you can watch, or another stock in the same industry, is BNTX. And BioNTech has been making a good little push back here. You can see in the last couple of weeks, really kind of pushed up there to 170, pulled back there, and then held the pullback. Now it's trying to get back up through that 170. We'll see if it's able to go ahead and do so. All right, that's going to do it for healthcare. Let's go into technology. And what led in some technology names is, you could take a look here. There's a lot that was kind of moving on up. I'm going to go ahead and pull on some of the semiconductors here. That was kind of leading, but there's some different stocks here. You know how big technology is, but stocks like AMD having a really good day. Look at that push. This has been pushing all the way from the 75 up there towards the 90 in about a week or 7.5 days. It's done about a 20% move. How much further can it go? Man, we'll take a look. We'll see what happens there. NVIDIA also making a big jump up, right? From around the 145 towards the 180s. Also over 20% move in the last week and a day or so. Another one that you can watch is ASML. I know this one isn't watched as often, but definitely having a good pushback in technology and semiconductor equipment and materials. These stocks have been really strong. And a big area where I was watching was the Qs today to see if we could get back up there towards around the 310 area is where I'm going to call some resistance into that area. We'll see how we react. Same thing for the SPY. Do we get through the 400 and see the turnaround? A lot of this, of course, led by Tesla in the consumer cyclicals area. And so we can take a look at Tesla here. And that was in consumer cyclical in the auto manufacturing. And you can see Tesla now at the 812s. This, of course, didn't only run Tesla. It ran a couple of stocks in the auto manufacturing. You could take a look at Rivian today. And one that I am fully out now, I can give you guys it, is Fisker. I was talking about this one in pre-market, how I was looking for a move up there towards the 1020s. This wasn't a big move. It was only about like a 3-4% move, but not a bad trade there. Already got out of Fisker. We'll see if it can continue to run and kind of push with Tesla. That's why I was watching it, to see if it could get a nice lift with the EVs. And we'll also talk about Ford. Ford had news today. That's going to be coming up just shortly after our guest. All right, let's continue going. What was on the downside? What was not hot, right? Well, downside was utilities, energy, and communication services. Energy leading to the downside. And if you take a look now, I think communication services just leaked into the green, and so did utilities. So it's not like they're in the red from the open, but they're just slightly up there. Energy down about 0.13 here from the open. Overall, about 2.39. And you can take a look at names like XOM and see how that pullback happened here. We'll see if this can continue pushing, right? You can see it in the pre-market. It really was with crude getting pushed down. If you guys looked at the morning, you saw crude down. It was definitely dragging these stocks in the morning. They're coming back a little bit. We'll see if they're able to get back to yesterday's close, which was way up there, closer towards the 89 on XOM. All right, let's get out of what was hot and what was not. In a second, we're going to get into our earnings. And then, of course, we have our first guest that will be coming on up in just a few minutes, actually like a minute. So what I'm going to do is I'm not going to get into Tesla's earnings because I'm sure that you guys want to talk a little bit more about Tesla's earning. I'll get into a surprise one for me. One that maybe not too many people were watching their report, which was Travelers Company. It caught my eye, especially with a beat like it had, and then a pullback like it had in the pre-market. This was up about 4% in the pre-market, and then came really right back down and pulled back about like 9% here. So I'm keeping my eyes on Travelers Company. Of course, is an insurance company, so not the the sexiest name that you hear out there, but the EPS coming in here at $2.57, beating the $1.96 estimate. Sales also beat here, 9.14 billion, beating the 8.76 billion estimate. So at least on the earnings wise, this seemed like a decent report to kind of keep a watch out. It's right near the support around, let's say, the 150s area. So I'm trying to see if it can come back and trying to fill up here into the shadow where it kind of gapped down. That'd be a play back into the 159. Right now, it's not doing it, but I'm going to definitely keep it on my radar to see eventually if you can find some stabilization here and then make a move back up through those 160s, trying to fill some of the gap. We'll see what happens there on Travelers Company. All right, I'm going to go ahead and get out of this insurance name. In a second, we're going to dive into our interview. Like always, we'll play a little bit of a Benzinga Pro trailer here and then get into our interview coming on next. So if you guys got a question here, definitely throw it up in the chat. We're going to talk a little bit of the macro situation. So if you guys have anything towards that, feel free to throw it up in the chat.
Introducing portfolio synchronization with your brokerage. Now you can securely connect your brokerage account to Benzinga Pro, opening a world of personalization. Screen lightning fast news just for the stocks you own. Set alerts for news catalysts that affect only the companies you care about. It's all possible with a simple click and a secure protected connection. Overcome uncertainty and connect your portfolio to Benzinga Pro today.
All right, let's go ahead. Let's bring on Randy to the show. Randy Frederick, Managing Director of Trading and Derivatives at Schwab Center. Welcome to the show.
Hi, Mitch. It's great to be back with you again.
Yeah, excited to go ahead and dive into a little bit of the macro situation. We've had a rally, and I'm sure that a lot of the bulls are wondering what do you think about this recent rally? And do you think, this rally has some legs?
Well, no one knows for sure, of course, but if you go, obviously the market's been going down overall since the first day of this calendar year, and we've had at least 3, maybe 4 such rallies as we're in right now. Mm-hmm. We had a pretty solid bounce back, and just as it gained a little more momentum and people started to buy into it, then it turned around, headed lower again. Now, what could be a catalyst for that? Obviously, next week's interest rate hike could do that. Now, it's not going to surprise anyone. Everyone's expecting a rate hike. The odds of a 75 basis point hike, in fact, are 100%. We even had pretty high odds at one point for a full 1%. That's come down to only about a 25% odds. So I don't think that's going to happen. I think it's actually going to be 3/4. So no one should be caught off guard. And yet those types of events, even when they're expected, and we know the date, and we even know the time of day, market has a tendency to have a pivot. Now, I'm not predicting that we're going to get a downturn at that point, but we have seen this many times before. Historically, when you have a downtrend, when you get 2 good solid up days in a row, oftentimes that's an opportunity to step in. And we've had that again 3 or 4 times this year. And each time it's happened, it has not been sustainable. But it's pretty encouraging. One thing that I am probably most encouraged about is the fact that, and I think you were alluding to this earlier, all of the 4 major market indices, the Dow, the Russell, the NASDAQ, and the S&P, they're all above the 50-day moving average now for the first time in 3 solid months. That hasn't happened, obviously, for a long time. That's an encouraging sign. But again, it's difficult to get overly optimistic when you got another rate hike coming in all likelihood, probably in September, another one after that. So clearly we are starting to see signs that the economic activity is slowing, which is what we're trying to accomplish. But as you mentioned, the labor market remains incredibly strong. I don't know about you, but if you've been out to a retail store, to your favorite restaurant, tried to travel through the air, buy a car, all of those things are still, the demand is amazing. It's incredibly robust. I don't see a whole lot of pullback on the part of any consumer that I'm exposed to on anything discretionary. So the economy is still going quite strong, and it's still driven pretty heavily by the consumer.
Definitely, we've been seeing the strength, and just kind of point out, I've been watching also that market breadth. If you just take a look at maybe just simple moving average 50, and now we have 51.7% of stocks actually into the green, into the bullish side. So it's something that we're watching, that market breadth. Is it just a few stocks that are leading the rally, or is it a lot of stocks that are leading the rally here? Something definitely to watch. Now, you just kind of took my question on that 1 basis point, so I'll go ahead and I'll skip that. It's something that we'll definitely kind of watch to see what happens next week. Let's go to relative strength. Are you seeing any relative strength in any sectors out there?
Well, you see what you typically see, right? When you get a good solid update, the high beta sectors, primarily technology, consumer discretionary, those are the 2 big ones, of course, are leading the way. But that's what you typically expect of a high beta sector. When you get a down day, they will lead the way down. So, and then the defensive sectors where people have been hiding out for a good part of this year, places like utilities, like staples, in some cases, healthcare, although that's not the case today, energy, real estate, some of those are a little bit weaker. That's what you normally get. These tend to be the places where people go when the market's feeling a little rocky, and they're the places where people pull money out of when they start seeing opportunities for growth. We haven't seen much opportunity for growth for 6 solid months. So when you get these updates, people tend to have a tendency to jump into those sectors. And that doesn't mean that there's bad opportunity. There may be some good opportunities there. The main thing is, and we've been emphasizing this all year long, which is that there are a lot of good, solid tech companies out there that are big. In fact, some of them are massive, and they have huge balance sheets. They make enormous revenues and profits, and they've been around a long time, and you can count on the fact that in a few more years, they're still going to be there. These are opportunities to potentially buy some of these names while they're on sale. If you have a long-term perspective, they will likely pay off. Doesn't mean you're going to make money in a month or two, but if you've got an outlook that's a year or more long, odds are pretty good you're probably going to do okay on those. On the other hand, if it's a brand new upstart company, maybe came public last year via SPAC or something like that, where the only prospect they have is growth, and even that has been pretty ugly this year, maybe it's still good to avoid those names. So you can't just look at the tech sector as a whole. You got to slice it down into industry and really down into specific names. But you know what? All that information's out there. So make sure you take a look at it and do your research ahead of time.
Definitely. One of the areas that I've been focusing is on the groups overall and the year-to-date relative performance, because I think it's an important. I'm going to throw it in with an energy question coming up, but it's something that I would point out to retail investors definitely need a watch, as technology is down about 25.62% year to date. But energy, of course, is up 18.45 year to date. And now we're seeing a little bit of a flip here. Now, one of the things that I've seen is, of course, energy take a step back. Do you feel that the opportunity in that trade has come and passed, and now there's a bigger opportunity probably for tech?
Well, I mean, as you said, energy is the only sector that's been up virtually year to date, the entire year, and virtually every other sector has been down. That's quite unusual. Now, energy had a couple of really terrible years. 2019 and 2020, it was the worst performing. It was the worst performing sector for both of those years. But if you did what we always recommend people do, and that is at the end of each year, you rebalance your portfolio, you take some of your profits out of the high performing sectors, which in that case would have been, again, consumer discretionary and technology. You take a few of those profits off to get your portfolio back in balance. You buy some of the energy and some of the other really badly performing sectors, you'd be perfectly positioned for the next couple of years, where in 2020 and again, in 2021 and then again in 2022, energy has now been the leading sector. Has the best performance year to date been there? I mean, you could probably make the argument that the easy money has been made. Will crude oil get back to an all-time high again, or at least a year-to-date high? You know, it's difficult to say. No one can say for sure. I don't think it's going off a cliff. Demand is still there. We talk a lot about demand destruction, but frankly, I just haven't seen it. Gas prices went way up. Yeah, demand tapered off a bit, but now that prices have come back down pretty substantially here lately, I would say demand has held up. It's pretty robust. I mean, I go to gas stations all the time, and they're full all the time. And I see cars on the traffic is as bad as it's ever been. I just don't see that demand destruction. You might see some demand reduction, certainly a little bit. And some people are consolidating maybe their errands to some degree. But for the most part, people who are frustrated because they can't get on an airline or flying, traveling across country on their car, taking car trips. It doesn't seem to be a whole lot of a pullback there. So what I think that means is that gas prices are going to remain above average, or at least above the average where they've been for the last few years. Crude oil prices are going to stay probably somewhere around 100, maybe between 90 and 100, which is a pretty high level. And as you've mentioned, that means a lot of these oil companies are going to be making some pretty nice profits, and they have been. That's likely to continue. But whether there's substantial upside from here, I'd be a little cautious on them. Certainly, if you've got some baked in unrealized gains, again, maybe it's time to take some of that money off. And if this recovery continues, then maybe you look at some of those more discretionary type names again.
Yeah, I still haven't seen the consumer just give up their cars, and I see like 1,000 bikes riding down the street. Until that day comes, I'll definitely get worried that day. But let's talk about Q2 earnings and what we're seeing. Are you seeing any trends here?
Well, it hasn't been a very good earnings season at all. The expectations were that we'd have very modest earnings and revenue growth. So far, earnings growth is actually net negative. Where I think the analysts were expecting about 4% year-over-year earnings growth. We're about negative 8 or 9% right now. And it's still early. I think we only have about 17% of the companies in the S&P 500 that have reported so far. But overall, it's below expectations. And it's also below what we saw in Q1. So while there was an expectation for positive earnings and revenue growth, the earnings growth is actually net negative. The revenue growth is positive, but I think it's around 4%, but the expectation was for 10%. So it's also below what was expected. So we're likely to see, I think, overall, probably very moderately positive earnings and revenue growth. But in most cases, it's going to be lower than what we saw in Q1. And at least for now, it's pacing below what the analysts had expected. This is likely to be the weakest quarter since about Q3 of 2020. Remember what was going on back then. This is probably going to be our weakest quarterly growth since that time.
Well, thank you for joining me once again, Randy. We'll definitely keep watch to see what happens next week and to see how the opportunities kind of change. Do we get this rally to keep on going? We'll definitely take a look and have you back on, Randy. Appreciate it.
You're welcome. Nice being with you again.
All right, let's continue going here, guys. That was our first expert on the day. Now we're going to go ahead and continue going. Take a look at some headlines. We have a lot of earnings talk out there. As you guys can see, the trend right now is it was expected to be, as bad as it gets here for these earnings. And we have seen a little bit of, coming underneath, a lot of missing. But the question is, have they lowered the bar enough to kind of come in and not look too bad? Some of these companies, we'll talk about them. You guys tell me what you guys think in the chat. Do you guys feel that the companies are lowering the bar enough to try to come in and, raise that right back up? Let's take a look at some of these earnings. First one we're going to talk about, of course, is none other than the Tesla dragon, or Elon. Everybody wants to talk about Elon, so let's take a look at what happened in Tesla today. Of course, Tesla kind of getting that push in the intra market. I'll go and put a 15 minutes so we can kind of talk about it. You guys can see how this really pushed on up. And I've talked about before we got to the earnings, how if we were looking at the move, I was looking to see if we were going to crack 700 because the move back above 750 left room for this push back out of the bearish pattern. Now getting towards that 800, a close above 800 is going to get me a bullish here, at least on the technical setup, as you're getting out of the bearish trend. And what did we get in the actual earnings here, though? The EPS was at $2.27, beating the $1.91 estimate. Sales at 16.93, but missing here 17.39 billion estimate. So almost, missing by $1 billion here on the estimate. And so what does that show me? Margins are compacting, and a lot of that I saw there in the kind of, you look at the cash flow and the revenue, the income statement, you'll see there that the cost of the vehicles are going up. And that's why you're also seeing them raise the actual cost, the retail to selling it, the suggested retail value there. And you're seeing them try to get a little bit more money because the materials are costing more. Tesla did say at the end of Q2 that they converted approximately 75% of the Bitcoin purchases into fiat currency. The conversions into Q2 added $936 million of cash to the balance sheet. which a lot of people were pointing to. Would this have been negative if that conversion did not happen? And from what I saw, it would have been negative. So it's interesting to keep on watch. Now, second quarter deliveries were up 27% year over year to 254,695. The interesting thing for me to watch is kind of mentions of what the Cybertruck, right? Cybertruck is expected, they say, mid next year to start coming out of Austin. And I think you got to keep watch because products, I think, are what going to get Tesla back there towards 1,200. I don't think it's going to be just the vehicle itself. It's going to be more talks of the semi, more talks of the Cybertruck that can really give Tesla that next kind of round of innovation and to get us back up there. But you guys in the chat, let me know what you guys think about Tesla and Elon. Do you feel like this is the time where Elon and Tesla can get back up there towards that 1,100, getting towards the all-time highs? Let me know in the chat what you think. Put a 1 if you think we get back there in, let's say, a year or so. Put a 2 if you think, nah, we ain't getting back there, at least in the next a year or so. All right, I'll see what you guys say in the chat. I'm going to continue going to the next earnings stock here. Let's go towards United Holdings and how did that perform today? Boom, knocked down right there. That's what I kind of expected, a run into the earnings. And then, of course, what happens? Earnings come and then gets hit right back down. The same way I felt about American Airlines that was leading. And you can see this actually leaked a little bit more than just the pre-market leak. United Holdings here, Q2 EPS missing and revenue missing. EPS at $1.43, missing the $1.94 estimate. Sales at $12.11 billion, missing the $12.17 billion estimate. They did turn profitable in Q2, but missing the analyst expectations. And then, of course, following that one, American Airlines. Let's talk a little bit about that. So American Airlines Group also, but they come in a little bit better. They missed here on EPS, but beat on the revenues. EPS missing by a cent at 76 cents, missing the 77-cent estimate. Sales were at $13.42 billion, beating the $13.41 billion estimate. American Airlines expects Q3 sales up 10 to 12% compared to 2019 levels. So keep watch on that. You can see American Airlines coming back. And to me, it's just more about the matter of the 50% and 61.8 retracements. So somewhere between 1326 and 1370 is where I expect American Airlines to find some support. We'll see if it's able to find that support on the pullback. All right, I see some chat mentioned there about Tesla. I saw there's some 2, 1. All right, 1, 2. Some people don't feel like we'll get back there. We'll see what happens if Tesla can get back towards the all-time high. And now I'll throw you another question, chat. Let's get out of American Airlines. Let's talk about Carnival Corporation announcing that $1 billion offering at $9.95. Let's take a look at Carnival. How's it trading today? You can see it's pulling back really closely to that $7.95. I mean, it didn't go too far from that. I know the arbitrage traders are probably nailing that. Now the question is, what happens to Carnival, right? Does it come back down for the lows to the 8s? Or do you see it hold here and then get back up through the 10? I'm going to lean a little bit more on some sideways action. I think right now they just don't know what's going to happen. But I have pointed out how the CDC has changed in the guidance here and how that could affect bookings coming up in the next quarter. So keep on watch. I think you need to see a strong quarter from Carnival, or at least announcements of kind of bookings getting stronger and stronger as we get out of summer going into the next year is what I want to be seeing. Can they make mentions of next year and how that outlook is going into play? All right, let's continue going. Let's take a look what else is being mentioned. Let me know in the chat here. Put a C if you would go on a Carnival. Put an X in the chat if you would not go on a cruise, at least this year. Is that still a worry in the consumer's mind? I'll tell you one thing. They can sign me up. I'll go on a cruise. I'm probably going on a cruise more than likely next year. Might not be this year, but I'm going on one. Bill said, I ain't for those cruises. Hey, can't blame you, Bill. If you don't like them, you don't like them. Patrick says, nope, not for me. And so does Beach Bum. Interesting that Beach Bum would say that. He's right by the beach. Guess he said, I don't need it. Looks like no one's going on the cruises. There's Shannon. Shannon will go on the cruise. Don't worry, Shannon. We'll send these guys pictures while we're out there on that cruise in the Caribbean islands enjoying it. But who knows? Only because I pissed off the Poseidon years ago. Hey, Jonathan, don't get in trouble with those cruises. All right, let's get out of that. That was an interesting conversation. I appreciate you guys commenting in the chat. That's what it's about too. I want to know what you guys think. So let's keep going here. Let's get into let's get into a couple more earnings. Let's go to Las Vegas Sands. How did this one perform? I think they need to change their name here. They need to change the name to, it's not longer in Las Vegas. So, I mean, this one actually held the gain there. I talked about how you wanted to see it hold the trend. Some people wanted to point this out in pre-market prep that, maybe it doesn't matter that trend, but I think it matters. I definitely think it matters. Look at that hourly trend. It's held it until it breaks that. I think it's still in the bullish sense. Right now, it's trying to get through 40. Here they missed really badly, actually, but at least beating on the revenue. They missed here. Their expected EPS loss of 27 cents, and it came in at a loss of 34 cents. So worse than expected there. Sales at 1.5 billion, beating the 976,000 estimate there. So it wasn't the worst on the revenue, but definitely missing on the EPS. Last one we'll take a look at is, of course, AT&T. The reason why I say take a look at this one is because you'll probably also see Verizon reacting on this one, and they are scheduled to report tomorrow, so keep your eyes on Verizon. But AT&T here, adjusted EPS beating on revenue, EPS at 65 cents, beating the 61 cent estimate, sales at 29.64 billion, beating the 29.56 billion estimate. Now, the one thing that they did point to the downside here was they changed kind of the full year free cash flow guidance to being 14 billion to reflect heavy investments in growth, working capital impacts related to the timing of collections. So there you guys see some negative cash flow guidance, and that's what really kind of knocked it down here on AT&T. All right, let's get out of this AT&T story. Let's go to Microsoft as it was expected. And this was a report. It wasn't, confirmed by them. It was mentioned that they were eliminating many open jobs, including Azure cloud business and its security software unit, as the economy continued to weaken. That's why you saw a little weakness in the pre-market. It kind of bounced on up. It's holding up right now. Of course, we got mentions of similar headline in Apple, and you guys seen how Apple's been actually going up after it did that quick drop that it did. So, hey, I don't know if this news is affecting the stocks as much as we feel they are. Let's go to Amazon after they're buying here the healthcare provider One Medical for about 3.19 billion. It was going up here. Let's take a look there. That was a 1W. I'm just going to leave it alone. I forgot the ticker there for One Medical. Let me see if I can find it here. Yeah, I don't find it right now. I didn't have it pulled up there, but don't worry. The biggest thing, the point here is how Amazon's stepping into healthcare providers. And that's really affecting stocks like Walgreens and affecting stocks like CVS that were stepping up there. One of the things that you want to pay attention to always is competitors, right? Stepping into the healthcare industry. And here you're seeing Amazon really step on up and into an area that, is led by, some leaders like CVS with their, with Aetna purchase. And then, of course, you can see Walgreens here. And they are recovering a little bit, so it's not the worst move, but something to keep on watch. All right, let's get out of that Amazon news. Let's take a look at Ford. Ford had multiple news that came on out, so I definitely tell you guys to take a look at Ford to see what happened today. Let's go ahead and let's take a look here. You can see it was boosting in the pre-market. A lot of this after they mentioned securing 100% of the battery supplies needed to deliver electric vehicles at the rate of 600,000 per year at the end of 2023. It's something to definitely keep on watch. Thank you guys. I see you guys in the chat, Jesse and Patrick, 1M. I thought it was that, but for some reason it just looked a little bit weird. But Ford also planning to slash as many as 8,000 jobs reported by Bloomberg, that they were going to boost investments into electric vehicle manufacturing. And it just seems like a lot of it's just pointing towards the EV. So it's a nice little boost there in Ford. The question is, will it continue to rise, right? It's already been running a decent amount. It's already gone up at least today about in the last 5 bars. So about a little bit over a week, it's up about 15%. So the question is, can it get through that 13 and continue pushing? It's going to need some more positive catalysts, but it's definitely pointing right now to the upside. We'll see if it flips. All right, catching up with the chat. What are you guys taking a look on out there? What's catching your attention? I did see some stocks mentioned earlier, so I'm going to scroll on up, see if I can go ahead and catch that stock. I did see Workhorse going to make another massive run with USPS talks. That's a hard one there. The Eight Father is calling out there. Workhorse, I know that they're getting mentions of it. The question is, will it take off? Of course, you can see here, some people are definitely playing this play. You can see because of that 20 million stepping up to the plate there in Workhorse. I think, this is a hard one to kind of call. I've called it before and it went well, but then again, everyone thought that they would get the postal contract and they just weren't able to. They weren't able to keep it. And so, that went to Oshkosh. So maybe take a look at Oshkosh to see how that kind of performed. That's OSK. You would want to see OSK really coming down here and showing some weakness. And that's what I would want to see. And that's not what I'm seeing right now. I'm showing strength also on there. So at least in my eyes right now, I'm not certain about the Workhorse deal, if it's going to go through or not. Of course, there's just some kind of mentions there. We'll see what happens on Workhorse. Did someone just really mention Rev? Yeah, Revlon here at 569. I mean, it's holding on relatively well for a stock that kind of went into bankruptcy or Chapter 11. I don't know. Not something that I'd be trading, but doesn't look too bad. All right, let's continue going. Amazon will break on their own weight soon. Hey, we'll see what happens there. All right, let's see what else do we want to go ahead and mention before we get into our next interview. Our next interview is going to be really fun, guys. We're going to talk to Dr. Richard M. Smith, market risk analyst, and they call him the doctor of uncertainty. So stay tuned for that. That's coming right on up in about 3 to 4 minutes. I'm going to go ahead up and play a trailer, and we'll be right back.
I tell all my CEOs, this is a very, very, very important platform. And look, all the other platforms are important too, but you're up there now. You're way up there.
Best investments you can do in your future is actually go and re-educate yourself on credible sites and credible resources like Benzinga. I think you guys have been killing it.
The comment section on this show is remarkable. Like the quality of the combo, and just big shout out to you and your community.
So I love about you guys, you just had all your callers in right then. And it's all about the community here at Benzinga.
What's up, traders? How we doing on out there? Smash the like if you guys are enjoying the show. We've covered a bunch of headlines that are out in the market. We've talked all about the ECB. We talked about natural gas, Tesla earnings, United, Carnival, Microsoft, Amazon, Ford. We talked about some inflation and some Fed outlook. Now we'll be getting into risk and uncertainty and portfolio building in just a short second, getting into our interview. Do want to take a quick look at the SPY to see what is going on out there and to see if we're getting that continued run. We still got some legs. Let me take a look. All right, SPY now up there towards 396. Can we get back through that 397? Get up there towards the 399 today is the area that I'll be watching to see if we can get off there. And it's going to be interesting. The SPY has been running really well. And a lot of this, I think, based on tech, but you guys can see here, healthcare and tech still leading us right now. Let's take a look there. How are our big components doing? All right, Apple up now. Hold on one second there. Apple up now 1.36%. holding well. I remember when this was at the bottom of the range early on in the day, I was talking about if you feel like we're going to go back up towards those highs and get that push, Apple's going to be interesting because it was coming actually down when the markets were going up. And that was the interesting fact that I was kind of note there on live trading, the divergence there. And now you're seeing Apple trying to hold. I've talked about how important it was to get back above that 150. Now it's really starting to turn things around here. If it can get back above 160, recover that moving 200-day, get back into that long-term trend that it was holding. That was before 2021. That was in the 2020s. Let's see if it can get back into that long-term trend. All right, in a second, we're going to be getting into our interview. Just about a minute here. I did want to take a look at just really quickly how our tech leaders have been doing. NVIDIA just continuing to push there, up there almost to the 180s today. Tesla still holding that 800 up there now to 813s and continuing to push. We'll see what happens in this name. And if Tesla can close above 800, I talked about it, it's going to be an interesting chart to watch. Also, I'm seeing Netflix kind of change the tunes here, looking interesting over that 220s. It's kind of holding on right now. You can see here how we really started to push back. I've talked about above the 230 level. I'm going to be watching this one because it has a huge gap up fill, but we could see some sideways action once we get through here. It's interesting to see Netflix kind of changing tunes from the bottom there. All right, let's get out of the charts here. We're going to dive into our interview. Ready to go ahead and get into it here. Just give me 1 second. Let's go ahead. Let's dive on in. This is going to be our next interview, and I do want to go ahead and give you guys some insight before we get into this. We'll give you guys a look in the description. You guys are going to see 2 links by Dr. Richard. If you guys want to kind of follow along with us, you're more than welcome to, as we go ahead and dive on in. Let me go ahead and bring on here Dr. Richard Smith, market risk analysis analyst and the doctor of uncertainty. Welcome to the show.
Hey, Mitch. Great to be here. Thanks for having me.
Yeah, excited to talk about it, especially in an uncertain time. What better than to talk about uncertainty and risk management? I think This is definitely one of the biggest, most important things that is to the investor, but most people just don't talk about it as much as needed. So excited to dive on in. First thing I want to do, of course, is go a little bit more into the platform, because you do have a platform that comes from your research. What is Rick Smith, and why would traders and investors use the platform?
So Risk Smith, I know it's a little bit of a tongue twister, but it's all about bringing this other kind of perpendicular dimension to investing that most people are missing, and just focusing on risk, right? I've been in this business for 20 plus years. I've helped tens of thousands of retail investors. I know what retail investors go through. And so there's tons of great resources out there for helping us to, time markets, to do good research on what might be a good value or a good trend, et cetera. But investing is so much more than that. And trading is so much more than that, right? Yes, you have to have good, but you also have to have a portfolio of good investments, right? Or good trades. And that the portfolio building comes from correlation and volatility, coupled with, your strategy for making sure you're in something that's going to go up more than it's going to go down. So that's really kind of how to bring this, to make these professional grade tools accessible to the public in an intuitive, fun, not overwhelming way. You don't have to go get your MBA from Penn, to understand correlation and volatility. And, and ultimately get it into a mobile footprint where it can basically be with you at all times. So a lot to talk about there. I'd love to get into it. But where would you like to go, Mitch?
Let's go into it. What part of the platform is really focusing on correlation, right? And how should correlation really play into building a portfolio? Any tips for the retail traders out there?
Absolutely. So first, what is correlation, right? So correlation means that, well, if things are correlated, it means they're moving together, right? So maybe Apple and Google are pretty correlated. They tend to go up and down together on any given day. Things that are uncorrelated are things that don't move up and down together. So, maybe Apple is uncorrelated to, say, Federal Express. I don't know. But those are the kinds of opportunities that you can use RiskSmith to help you build a portfolio of uncorrelated assets. And when you do have uncorrelated assets, Ray Dalio called this the Holy Grail portfolio. 15 good uncorrelated return streams. So good means they're going to go up, right? And uncorrelated means they're not all going up at the same time. So when you have uncorrelated, good uncorrelated return streams, you get a smoother overall ride for your portfolio, right? And at the end of the day, Mitch, that's what really moves us, is making sure that all of our, assets are moving up, together, not all at the same time, but collectively going up, right? We might be in a position that's going against us for a period of time and we got to wait it out. But as long as that's kind of counterweighted with other things that are working, while that position is not working, that puts us in a much better psychological position in the markets. So we don't end up making emotional decisions, that we will eventually regret, because anybody who's been in the market for longer than, 60 seconds knows that the market is going to do everything it can, to turn you upside down and shake the money out of your pockets, right?
Yeah,
so that's what markets are doing, man. It's a war out there. And those who, it's such a difficult time right now, especially, Mitch. People are still anchored on, the good old days of 2021 and thinking that, man, that's got to come back.
So you don't just put all your eggs in one basket. That's not the approach that
you don't
works.
put all your eggs in one basket. And this work, these are the simplest principles of risk management that no professional would be caught dead without. But for whatever reason, they just are not talked about in the retail space at all.
Now I'll keep getting us moving here. Now, one of the interesting parts, I think, of the platform is how the standard deviation data is used, right? I know a lot of people probably hated that word in math class, but in here in investment environment, that's actually a good thing to hear. Let's talk a little bit about that. How is that data used within the app?
So in a couple of ways. One, the most important one has to do with volatility. And again, I've been in this for 25 years now in the markets. Literally, my PhD is in decision making under uncertainty. Okay. So I wanted a practical space where I could help people make better decisions under uncertainty. And the markets have been a great place to do that. And I got interested, frankly, in markets, Mitch, back in, the late 90s, 1998, 99, 2000, when we were going through a similar time as what we're going through today, right?
Yeah, definitely.
So the standard deviation is one of a number of, metrics, math formulas, if you will, that tell you, how much something moves up or down in a given period of time. Okay. So, and how much something moves up and down is a very important thing for you to know, right? Because, well, what you've got on the screen here, these are histograms, and this is showing you, I don't know, which one is this? If you scroll back up to the top here.
This is normal.
Oh, volatile and normal, right? And stable.
Volatile,
right?
normal,
Okay.
and stable.
Yeah, but you can see if you scroll down a little bit, you can see tickers going across the bottom there, right? Bitcoin is kind of has what's called fat tails there, okay? So that means that Bitcoin's regularly up or down by plus or minus 5% in a day. And if you click on the volatile kind of prototype up above, that's showing you, if you looked at Ethereum, for example, or, even more Dogecoin, and you can do that, by the way, but you're just kind of outside of the, the paywall right now, but there actually is no paywall. This is free right now. You can sign up for free.
There you guys see it.
Yeah,
There
you got to that yet. But this is really good to know. If you're going to invest in something really volatile, you can see it at a glance. This is really volatile, right? And the reason it's so important is because, it's actually not the volatility so much. It's the volatility plus how much money you have in that asset. Okay. So, if you have $1,000 in Bitcoin versus $1,000 in SPY here, right? It's going across our screen.
Yeah.
SPY is not going to have those big, $500 days, right? To the downside or the upside, right? It's going to be more normal. You're going to have, it's going to be more like what you expect.
Yeah. And I love how it's stated here, like wild days are rare. And I think that's one of the things that you're looking for, right? Sometimes we're just trying to stay outside of the unknown and kind of the uncertainty.
Right. But here's the beautiful thing too. Like you can be in something volatile with a small amount of money and you can still be quite comfortable with that because now that it's volatile, you put less money into it. Okay. Then your personal volatility, which is the volatility of the asset plus the amount of money you have into it, right? So if you have $1,000 in Bitcoin, you're going to regularly get moves of $50 to $100 in a day, 5 to 10% in a day. That's not unheard of in Bitcoin, right? But if you have $100 in Bitcoin, right, a 5 or 10% move is only $5 to $10. So that function of the volatility plus your position size is really what makes you either strong hands in the market or weak hands. You're a weak hand or you're a patsy if the market can move your position in such a way that you can't take it anymore and you get forced to make a decision that you didn't mean to make, right? Mm-hmm. So that's why understanding volatility is so important. One of the biggest, most important things that I've discovered over my career is what I call volatility-based position sizing. And basically, I position size inversely to volatility. So, more volatile assets get less money and less volatile assets get more money. And so overall, you have what's called risk parity. I know it's kind of a hedge fund word, Cliff Asness at AQR was one of the pioneers here. But it's so important to be in the markets in a way that you can survive, right? And wait until the tide starts to turn in your favor again, and the worst place you want to be is in a position where you can't take it. And you've got too big a position because you've been doubling and tripling down along the way thinking, this can't go any lower than this, right?
Yeah.
You get yourself into a tough spot and then blammo. It happened with gold, just today, right? I mean, gold, hit 1700, bounced back up. Everybody thought, phew, this is it, back up to what gold's supposed to do. Then they crushed it down to like 1650, right? And if you're in a position that you can't hold through that because either, you've got too much leverage or too much money in that asset, you're going to throw in the towel at exactly the wrong moment, right? Yep. So this is all about, not throwing in the towel at exactly the wrong moment because you've got staying power because you're in, multiple assets that are uncorrelated where one gives you some cushion while the others, not going your way. You've got volatility-based position sizing so that, you're not too much in one thing that's really volatile. And ultimately, I think the retail investor really can be successful in the markets, has a unique role to play. I've been, that's been my career to help retail investors be successfully involved in markets, self-directed investors. And we can do it. We have a very important, significant role to play, but we got to be smart. We got to use the same tools that the pros do, and we can't just be degens, right? Yeah. Degenerate gamblers who are just sitting in front of our screens popping off.
Yeah,
it's not good enough. We're not going to beat the market by doing that.
Yeah, I say we leave that degen stuff to the sports betting on the weekend and then do our actual quantitative ideas here in the markets.
Yes.
Now,
Amen.
one of the things that we've been hearing often is the death to the 60-40 portfolio. I think this is an interesting conversation as being someone that studied finance in school. You know, that's all you heard. That's all you heard, right? 60-40, 60-40, and how you could balance that out and try to work that, you know, sharp ratios and all that fun stuff. But why is this happening? Why is the talk of the death to this kind of portfolio? And is it true?
Yeah, I think it is true. And I think there's a couple of reasons for it. I think one reason is that the 60-40 portfolio is really a marketing gimmick. You know, it really has been a big marketing tool for the industry. And when something's just a marketing tool, you know, it's eventually going to not work, right? It may have worked for a while, but look, like we said earlier, the markets are a brutal place. If everybody is naively going in one direction, there are plenty of market participants who are willing to arbitrage that until it doesn't work anymore. So that's one of the big things about the 60-40 portfolio. But the other thing is that, you know, bonds and stocks have been much more correlated, positively correlated than negatively correlated over the last few years, right? So again, you know, this idea of not correlated, right? If stocks are going down, bonds are supposed to be going up, or at least holding their own. And for the first 6 months of 2022 here, we've had the worst combined performance of stocks and bonds in history. Yeah. And so the correlation broke down. I have a thesis about why it broke down. I think it's primarily because of the Federal Reserve. And I think that they've been, you know, we don't have free markets right now. We have Fed markets. Everybody's looking to the Fed to say, what should I do in the markets, depending on what the Fed's going to do, right? So that, you know, financial assets in general have been inflating, especially since the pandemic, right? I mean, it was bad before the pandemic, and then the pandemic hit and it just exploded. So Rich, that is a lot of air.
Richard, I'm going to have to get you to talk about that a little bit deeper. We're going to have to do a little bit of talk on that. I think it's an important thing. I think it's something that we could talk, you know,
it's very important, you know, but in essence, that air is coming out of that Fed bubble right now, and it's pulling down all financial assets because financial assets have been inflated. And
can't fight the Fed, right? Can't fight the Fed.
You can't fight the Fed, but it's tough because, you know, they're coming out, the confidence in the Fed waxes and wanes. Ultimately, I don't think they're on a very confidence-inspiring course, and I think there's going to be, you know, what to pay.
Yeah, exactly.
Before all is said and done.
Now, one of the experience that I wanted to tie in,
which does increase uncertainty, by the way.
We don't need more increasing, but I know that you had experience trading in a .com era. Can you tell us how you kind of learned going through that and how you may be playing it into what you're seeing today?
Oh, yeah. So, you know, 1999, I'm in graduate school and working on my PH.D. in decision-making under uncertainty.
That must
my $10,000 account.
Perfect time to get into that, right?
My $10,000 account at the time, TD Waterhouse, right, is at like $40,000, you know, March of 2000. So I'm patting myself on the back, telling myself what a smart guy I am, you know, how that PhD is really playing off, but it was really just a bull market. And then March of 2000 hit, and you know, my $40,000 account became $30,000 in a very short period of time. And I thought, whoa, ouch, that hurt. You know, it took me longer to get from 30 to 40 than it did for me to get from 40 back to 30. And so I said to myself, well, you know, hey, let's not get greedy here. We'll just get out when it gets back to $35,000. And then it got back to $35,000, and I said, "Hey, self, that was pretty smart. Let's just stay in. Maybe you can get to $50,000." So, you know, one of the troubles with, being educated or having a high IQ is that you're really good at telling yourself stories, right? You can really weave a yarn about why you're right and the market's wrong. So anyway, I went through that. I didn't get back to 50,000 very quickly. I was back to $10,000. Lost 18 months of gains in about 1 month, and just went away with my tail between my legs. Going, what the heck just happened to me? So that really started a lifelong fascination with markets. I hope that's what comes out of the past 6 months for other young people,
exactly.
Who are right where I was, 25 years ago, right? Or 22 years ago. So,
well, Richard, I would say to those that are thinking about this or maybe just starting to dip their toes, check out your upcoming book, right? We got to talk a little bit about that. I don't know if you have a release date for the Risk Manifesto, your new book that's going to be coming out. What should we look out for, Richard? Anything? Any sneak peek on the date?
I don't have a date. I don't have a date right now. I've been working harder on my software than on my book. So my software, RiskSmith, is
the passion projects out there.
Is the passion project. Startups always take longer than you think they are going to. So, but the book is coming. I hope it'll be out in 2022. I don't have a firm date for you, in part because we are working so hard on the platform right now. Really excited about where we're at and where we're going. We've got a really compelling user experience, and everything is kind of focused on a 1-year time horizon right now in RiskSmith. So just a heads up about that. We're going to be getting it down to shorter time horizons as we progress, but getting it all to scale, getting it all to compute, and making it intuitive and user friendly. That takes work and money, by the way.
Perfect. Perfect. Hey, well, I did throw up there to give a little bonus there. I threw up the link so that you guys can sign up for the free newsletter. I would definitely check that on out. Appreciate you coming on, and we'll definitely have you back on, Richard.
Awesome. Great to talk to you, Mitch, and good luck to you and your followers.
Yeah, thank you. Appreciate it. All right, that's going to do it for us. We went a little bit of overtime there. I hope you guys enjoyed today's interviews. We covered it all. We touched a lot of topics. We covered all the headlines all in 1 hour. That's what this show's really all about, getting to the expert opinion, covering the information that's out there, and trying to keep you guys in the informational edge. I'll see you guys next time on Stock Market Movers. Up next, you guys got the roadmap. They'll be getting into none other than some NFT knowledge. Looks like Minecraft banning NFTs. What is going on in the NFT world? You guys, you want to go ahead and find out? Come on over to the roadmap. It's up on next.